We're talking about property taxes today and just how surprisingly punishing cryptocurrency taxes are. Hi, I'm Keith Weinhold. This is Get Rich Education. Why do some states have a high property tax but zero state income tax like Texas? Why wouldn't they do it the other way? What about a state like Alaska that has a moderate property tax but no other income taxes? And then what about a state that has a high tax for everything like California? What are the motivations and the trade-offs there? Yes, CPA Tom Wheelwright is back to discuss those issues with me, and then we're going to pivot into talking about cryptocurrency tax. We talk about how reporting standards for cryptocurrency owners are becoming more stringent, as well as the taxes on them. And something Tom and I discussed offline is when you have a cryptocurrency interest-bearing account, like you do with, say, BlockFi or Celsius, and say you store Bitcoin over there, they typically pay you interest in a little fraction of a Bitcoin. You might think that they do that because that way you don't have to pay taxes on it until you convert that Bitcoin to, say, dollars. Oh no, that's not true. You actually have to pay tax on it as time goes on, even on those crypto interest-bearing accounts. It's Tom Wheelwright, CPA, and I today talking about property and cryptocurrency tax. I'd like to welcome back the most recurrent guest in show history. He is the founder and CEO at Wealthability, and he really specializes in helping business owners and real estate investors and others reduce their taxes to almost zero. He's the author of the mega popular book, Tax-Free Wealth, and he's the Rich Dad Tax Advisor. He is CPA Tom Wheelwright. Welcome back.
Thanks for having me, Keith. Always good to be on your show. Always good to be with your listeners.
And there's so much to talk about when it comes to taxation. And a lot of times we talk about that in a national perspective because a lot of those gains types like capital gains and income tax rates are all tied nationally, but they're also specific state by state tax laws, very tied into what Congress and the legislature are often doing. Tell us about some of those more noteworthy United States state specific taxes, Tom.
Property taxes are a huge tax burden, particularly on real estate investors. And there are actually some things you can do on your property tax. So they can be challenged. And unlike the IRS, they're not, you don't have to wait to be audited. You can actually affirmatively challenge with your county assessor. And so you just hire a property tax professional, and what they're looking at is, are you paying more proportionate to your value than your neighbor? Are there any mitigating circumstances that might help you reduce your property tax? It's something that every real estate investor should be paying attention to, and very few do. And so that would be one area that definitely I think real estate investors ought to be paying attention to. The other interesting area, this is a kind of a new thing that's going on with the states. We have about 20 states now that have enacted an entity level tax for pass-through entities. And the purpose of this tax, it's always elective, but the purpose of it is to deduct your state income tax. So not going to affect you up in Alaska, not going to affect our folks in Texas, but in a lot of parts of the country, state income tax is still a pretty big deal. And of course, we've got this, and we've had this $10,000 limit, right, on deducting your property tax and state income tax. So it's this combination of taxes. So here's what at least 20 states have done so far, is they've said, well, look, if you have a business and you elect, you can pay tax on your business at the business level instead of paying that tax as an individual. Okay, well, what that does is the IRS has said, if you do that, you can deduct your state income tax. So that's where, and by the way, you can do the same thing with property tax. Your real estate's a little different because your real estate, you get to deduct your property taxes no matter what. So your real estate has their own special rules. You get to deduct them. You don't have any limit on your property taxes on your real estate because it's income producing property. But on your income tax, okay, any income tax, if you look at your income tax, you go, wow, it would be cheaper for me to elect to pay tax at the entity level because of that state tax deduction, then you might want to consider doing that. Arizona just added that to their laws. There are a lot of other states that have added that to their laws. And like I said, 20 states so far have added that. So regardless of what Congress does or doesn't do, with respect to income tax on the deductibility of state income tax. You do have this year-by-year election. Now, one thing to be really aware of, Keith, is that when you make that election differs state by state. So, for example, in New York, in 2022, you had to make that election for 2022 by January 15th of 2022.
The first 2 weeks.
You don't get until the end of the year to make that election. So you have to guess. Basically, you have to project out, is it better for me to pay the tax at the state level, at the entity level, or should I pass it through and pay it at the individual level? Other states, you make it when you file your tax return. So make sure that your tax preparer and your tax advisor, that they understand what state you're in and how and when to make that election.
Gosh, that is such a key tip. And I didn't think New York would make things any more relaxed with taxation. I really didn't think that they would be the ones. Well, Tom, when we look across the state-by-state landscape, some might wonder, now, why do states have certain tax plans, whereas others try to go a different direction? For example, you mentioned Texas earlier, where they don't have any state income tax, but yet they have a fairly high property tax in Texas. So what incentivizes or disincentivizes certain states from certain tax types? What's the motivation or the correlation?
You know, it's interesting because you're right. I mean, states are going to collect their pound of flesh one way or another, right? Some collect more. You know, California has a much bigger per capita budget than Texas or Arizona even. Same with New York, New Jersey, and some of the Midwestern states. But it's really those are policy decisions, very interesting policy decisions. I've had clients who have moved to Texas this year to avoid state income tax. And so state income tax is a big deal. I mean, if you look at California and you've got a 13.3% state income tax rate and you're making $1 million a year, that's $133,000. You are not going to make that up in property tax unless you have a really big property in Texas. So, you know, states can get their money either from income tax, property tax, or sales tax. A lot of states rely heavily, like Texas relies heavily on property tax and sales tax. Arizona, it's pretty evenly distributed between sales tax, property tax, and income tax. Property tax, by the way, is also used heavily for schools, fire departments, and police departments. And so if that's what you want to fund, then you tend to fund those with property tax, as opposed to funding those with income tax. There are some cities now, Portland just enacted an income tax for the city. Okay, so this is not just Oregon. This is the city of Portland enacted its own income tax. Washington, state of Washington, the governor just by declaration added a capital gains tax. Washington has an inheritance tax and a estate tax. Very few states have that, but Washington has one. So we think Washington is a no-tax state. It's not a no-tax state. They have their B&O tax, which is basically a tax on everything. And then they have their property taxes, and then they have sales taxes. And now they've got inheritance tax. Now they've got a capital gains tax. So don't believe anybody when they say we have no taxes, except maybe Alaska, which really has very low taxes overall. Though I don't know, with the current administration cutting down all the drilling up there, next thing you know, you're going to have an income tax.
Yes, and once a new tax is introduced, they don't seem to go away. I know that in Anchorage, Alaska, yes, it's known for having a very light tax burden. They recently introduced a 5% alcohol tax. I don't think that that's ever going to go away once people get used to paying it. And once they get used to paying that, it's more likely they'll get used to paying, other consumption taxes on cigarettes or gasoline or whatever it is.
When it's dark 8 months a year, man, you got to be drinking a lot of alcohol. So that's got to be a big revenue raiser.
You can't tax beer in the winter months. That's just downright wrong. Are there any other important trends when it comes to property taxes within certain states, Tom?
You really have to be careful with the property taxes because the assessors, these are not the best and the brightest, right? These aren't the highest paid individuals in the world. So you need to make sure you check your property valuation and make sure that it's appropriate and make sure that you challenge it really every year. I mean, you should challenge your property tax, especially on your rental properties. You should challenge your property tax every single year. And because if you, by the way, typically how a property tax professional gets paid is a percentage of the savings. So they don't save anything, you're not out anything. So I don't know why, people wouldn't do this every single year. I know big developers, they always challenge their property tax, always, always, always. So, that's one trend to consider. I think another trend to consider is that, again, let's go to the positive side of things, is that more and more states are enacting tax credits for charging stations and solar panels and windmills and, other, like Oklahoma did a huge campaign and put in and got people to put in hundreds and hundreds of charging stations in Oklahoma. And typically when you see that, it's typically going to be done through a tax credit. Now, sometimes it'll be done through a grant. In the infrastructure bill, for example, that passed in September, October, in that infrastructure bill, there are some grants for charging stations. So that's, the other thing to look at is that we think about tax credits, tax benefits, but don't forget that there are a lot of grants out there and they have the same effect as a tax credit. And so understanding what those are in your industry, your business could make a big difference to your bottom line.
Now, when it comes to challenging one's property taxes in order to get it reduced, what typically is the solution, or what does one cite there? Does one cite comparable properties and try to get the reduction that way? So what works when one challenges their property taxes versus what does not work?
I'll give you an interesting example. So years and years ago, I challenged the property taxes on my new built personal residence. And I went in, I said, look, I looked at my next door neighbor. I said, per foot, there's no question that you've valued my house way higher than his. He had a 2-story house. I had a 1-story house with a large basement. I lost. And the reason I lost, and had I really thought about this when I built the house, I would have changed the way I built the house. Because what the regulation said in my county were that if your basement was less than half the size of your main living area, then it was considered part of the main living area instead of considered a separate story. So that meant that even where a basement typically is worth less than a second story, in Maricopa County, if you had a basement, let's say my basement was 1,000 square feet, my main floor was, 2,300 square feet, so it was less than half. Had my basement been 1,500 square feet, I would have gotten a lower valuation than with my basement being 1,000 square feet, because they considered it now a 3,300 square foot ranch house, which of course has a better valuation than a 2-story, 3,300 square foot house. So those are there's little things like that. And that's why I typically would hire a professional to go in and look at it for me. But it's one of those things that even before you buy a property, like for me, had I looked at that before I built the property, I didn't even consider it, and shame on me. But if I looked at that before, I would have just built a bigger basement. That's what I would have done. I mean, I could have used the room, so why not? And because it wouldn't have been that expensive to build another, 200 square feet, which is really 200-300 square feet is all I needed. And then I would have been fine. So there are things like that. So you do look at comparables, but you also look at, there are technical rules that you look at. Like I said, in my case, I lost because of a technical rule, but there are just as many times where you win because of a technical rule, where you say, well, look, I'm a real 2-story house, so I shouldn't be taxed the same as this 1-story house next to me. So there's just all sorts of little nuances. and it's worth taking a look at.
Yeah, that's so interesting because most builders are thinking about things like a property's livability and utility, or perhaps how much rent they can get, and they don't often think about long-term ongoing taxation when they develop. Well, Tom and I are going to come back and talk about cryptocurrency taxation. You're listening to Get Rich Education. Our guest is Tom Wheelwright. I'm your host, Keith Weinhold.
Americans are not saving for retirement. It's going to get worse as people live longer, so you need to think differently, but you can't lose your time. Real estate is the investment vehicle that has created more million and billionaires than anything else. Get Rich Education is one of America's top investing shows disrupting Wall Street. Your host, Keith Weinhold, is a true financial educator and has been an income property investor since 2002. Get Rich Education has created millions in passive monthly income for its followers. Now, Keith has a free course. Real Estate Pays 5 Ways. Sign up now at getricheducation.com/course. Invest in what produces income for you now and later. Use the link in the description to take the course for free. Real Estate Pays 5 Ways. Get Rich Education is on every podcasting platform and has its own native iOS and Android apps. Join Get Rich Education Nation to create financial freedom through real estate investing. Subscribe wherever you listen.
Welcome back to Get Rich Education. We're talking with Tom Wheelwright, CPA. He's the Rich Dad Tax Advisor. He's the most recurrent guest in Get Rich Education history. He's such a familiar voice, you don't even need an introduction anymore. And Tom, we have never talked about cryptocurrency taxation, something that's really gotten a lot more traction and a lot more institutional buy-in in just the past 2 years or so, and it's seemed to become fairly mainstream now, but a lot of people don't understand the tax consequences that are related to cryptocurrency. So what can you tell us there?
There's more we don't know than we do know, but that's actually not a bad thing, because I've always preferred to have no rules than to have rules, because if I have no rules, I can pretty much just kind of follow what I think it ought to be, as long as I can make an argument for it. So I'm actually not unhappy with that. But we'll start getting rules. For example, in the infrastructure bill, they're gonna make Coinbase and the other exchanges. They're gonna make them keep track of your cryptocurrency transactions, and that's actually a pretty big deal. And I think that's a good thing. I think that's a really good thing. Now, here's what's interesting. I think that most people miss on crypto, and that is that you are taxed on a sale or exchange, not just a sale. And so if, let's say, for example, you trade your Bitcoin for Ethereum, because Bitcoin has not gone up nearly as much as Ethereum in the last year.
Right.
So let's say you say, oh, I'm going to get in on Ethereum. I'm going to trade my Bitcoin for Ethereum. Well, you sold, for tax purposes, you sold your Bitcoin. So you have a gain or loss based on the difference between what the price you paid and the value in dollars of the Ethereum you bought. Let's say, for example, now then it gets more difficult. Okay, let's say, for example, you have a Bitcoin credit card. Now, some Bitcoin credit cards, every transaction, it's like a debit card, and every transaction comes out of your Bitcoin account. Guess what? You have to track every transaction and report it on your tax return. Every single transaction where you use Bitcoin. You buy a cup of coffee with Bitcoin, that's a taxable transaction.
Right. There's no de minimis exemption.
None at all. So a better credit card, by the way, would be one where they just charge you, it's like a real credit card, and they charge you at the end of the month. Then you only have 12 transactions. You don't have, you don't have 365 transactions or 2,000 transactions. You only have 12. That's a much better way, frankly, to do that. And I think we're going to see more and more of that. The other thing to remember is now we've got alternative aspects of crypto, like NFTs. Okay, so let me give you a really, I'll give you a brain twister here. Back in June or July of 2021, Gary Vee, a lot of people know who Gary Vee is, very popular speaker and writer. He promoted a seminar, and the ticket to the seminar was one of his NFTs. And you had to use Ethereum to buy the NFT, which got you into the seminar. So here's the question. So we know that when you use the Ethereum, whatever the value was of that NFT / conference, you have gain or loss. Okay, that's the easy part. All right, but do you have a deduction? Let's say it was a seminar that would be deductible to you because it's part of your business. Is it really deductible? Because an NFT is an asset. And if you get an asset and then you get a seminar as well, is it like partially deductible? Is it fully deductible? Is it non-deductible? These are questions we really don't know the answer to. Now, we can make logical assumptions. We can look at what's the value of that of his past seminars. So we can kind of take a look historical, and we can probably say, well, that's probably deductible, and the NFT would be the difference. Now, what's interesting about his NFTs is that they are now, the NFTs that people bought to get into a seminar are worth way more than they were when they bought them. So they've actually gone up in value, and there's a trading platform for NFTs. So it gets really interesting. And then you have, mining, you have airdrops, you have all these different ways of earning cryptocurrency. And then the question is, let's say I mine cryptocurrency. And mining cryptocurrency really is not a whole lot different than mining gold or silver, right? I mean, you're literally mining it. You're just doing it digitally instead of in the ground. Well, if you mine gold, you don't pay tax on that gold until you sell it. So if you mine crypto, why do you have to pay tax when you get it? Well, the IRS says you pay tax when you mine it, not when you sell it, because it's immediately exchangeable into US dollars. Well, here's the problem. So is gold. So, it's no different than, let's say I manufacture, a vaccine. That's you can immediately turn that into money. Let's say that you just store it though. Is that taxable? Not until you sell it. So you have to look at that. The important thing when it comes to things like cryptocurrency, and we're going to get a lot of new stuff coming down the road, is to look at the fundamental principles of taxation. And this is why when you hire a tax advisor, you want a couple of things. One is you want somebody who really understands the fundamentals of the tax law and isn't just reading the IRS forms. Second of all, you want a tax advisor who can think, right? Who's actually looking at, okay, how would I apply this, and how can I make this a better situation for you, or how could you make this a better situation for you? And so you really want to pay attention. I think tax advisors, the good news is I think tax advisors are going to get more and more important, and there are fewer and fewer of us. So we're a little like Bitcoin. We get more valuable all the time, and there are fewer and fewer of us.
Yeah, that's right. There's a fixed supply there. And Tom, to do a little review, and I think part of what you're telling us is actually if you're a holder or hodler, is what they're called in the cryptocurrency world, and just hold on to what you've got, that's your simplest tax treatment there is right there, because you let us know if you sell or exchange cryptocurrency, there is taxation. And I think it's important to talk about that rate. We are talking about it's subject to capital gains tax rates. Is that right?
It is right now. It's considered property. And so it would be frankly no different than if you sold land. Okay. And so it's either long-term capital gains because you held it more than a year, or it's short-term capital gains because you held it less than a year. If you're a dealer, it's inventory. So it's going to be taxed as inventory. It's going to be ordinary income if you're a dealer. But if you're just a typical investor, it's going to be either short-term or long-term capital gain or loss.
And it's certainly interesting to talk about this legislation and these laws as they unfold, especially when one understands that SEC Chair Gary Gensler, he used to teach crypto classes at MIT. Increasingly, you seem to have these Congress members where you learn that they own cryptocurrency as well. So sometimes the people making the policy look out for it if they're a holder of it themselves.
For sure. Why do you think we didn't get an estate tax on real estate? Because the people in Congress, they own real estate. They didn't want the estate tax on the real estate. So no, you're absolutely right. It's just something you pay attention to. Have good advisors, have a good team. Just like anything in real estate, you want to make sure you have a good team and good team members and people who are paying attention.
Tom and I might continue to talk about this on future episodes. I mean, just imagine in the future, if you as a rental property owner, you begin accepting rent payments in cryptocurrency, or you do other real estate transactions or purchases or sales in cryptocurrency. Or imagine you, if you're trying to value your apartment building in cryptocurrency, and say Bitcoin is something that's really volatile and it doubles in value. Well, therefore, your apartment building over just a period of 2 weeks might go from a value of 50 Bitcoin down to 25 Bitcoin. Your building didn't lose any value, but Bitcoin doubled in value, and all these sorts of scenarios which have really interesting tax consequences.
Yeah, it's fascinating. And remember that there are a number of countries who have outlawed crypto,
Right?
beginning with China and several South American countries. So you also have to pay attention to that, especially if you're in other countries. I don't think it's going to get outlawed here. I think that they will regulate it through taxation, like they do most things. Remember also, they could add, if they decide they don't like crypto, let's say the US comes out with its own digital currency, which is likely, they might just say, you know what, we're going to make crypto tax the same as gold, which has a 28% rate, not a 15 to 20% rate. And they could just raise the tax rates on it. That is one way they could regulate it. And the other thing they're going to do is they're going to require more and more reporting on crypto, because we do all know that there are some bad actors that use crypto to for underground and nefarious purposes.
Yeah, 100%. Well, Tom can help you with this as well if you're interested in reducing your cryptocurrency transactions, in addition to being helpful with real estate and for business owners. Tom, if someone wants to learn more about you, what's the best way for them to get started with how you can help them?
I would go to wealthability.com and just click on schedule a call, and we're happy to look at your tax return. We're happy to see if there's a way we can help. And then if you just like a little bit more education, just pick up my book, Tax-Free Wealth. It's a really easy read. I've actually had people tell me it was a nice beach read. I'm going, I think you're a little sick if you're reading about taxes on the beach, but
I thought only you would do that.
Truly, I was told that it was a nice beach read. So it's a really easy book to read. Nothing complicated in it, not a lot of numbers, and it's a way to get more financially educated.
Tom, it's been enlightening as always. Thanks so much for coming back onto the show.
Thank you. Anytime, Keith.